Ladies and gentlemen of the crypto space, we're live on a Monday, October 7th at 12 p.m. So, as with my theming of these streams over the last probably couple of months at this point, I've gone full robotic. A machine. I've been there, done that. I'm too tired for all the bullshit games. I'm too old to want to put in excess work. And I've realized and understood that being mechanical and just adhering and understanding and comprehending and digesting and assimilating how the damn system works means I really don't have to do much work. Now, maybe in hindsight, thinking from my more novice times, that is akin to the concept of hodling. The hodl, as a blind faith procedure, is unreasonable, thus irrational. Blind faith in anything is scary. It is not scary to the point where it's like you need a leap of faith. It's blind faith and scary to the point where you should not engage in such behavior. You cannot be irrational. You have to have justification. You have to have a capacity to explain behavior, why you think something, why something is the case, and scientific method type shit. You got to be able to justify and provide answers. And that's where I've historically talked about the concept of dinner table investing. You need to be able to tell a story of why you do what you do, how you do what you do. So nowadays, that mechanical approach for me is really, what do I want to own? When do I want to own it? How much of it do I want to own? And there's two categories really. So in many regards, I'm very much in line and a full understander of the Bitcoin narrative. And in that regard, it's imperative to own that asset, but I'm also a tech investor and fintech especially, because I understand unequivocally that nation states will continue to do what they do. And that is not in terms of popular social media narratives. Oh, they're going to print. Oh, the debt. It's irrelevant. It's all irrelevant. Calm down. Woosah, chill. You don't jump on this stream thinking this boy is going to say Fed printer going to go burr. Money printer doesn't stop. Now, I like when Lynn says nothing stops this train, and it provides color, and that's something digestible by the general public, but that's not what it is. It's not. It's true. That's not what it is. The entire intent behind all these policies that has been labeled with Fed print to go burr is continuity of the system, preventing excess deflation. Deflation to the point where social civility collapses and John kills his neighbor because he hasn't eaten in 2 weeks. That is overwhelmingly the guiding principle of governments. And they will do everything they can to prevent that from occurring, including debasing the currency into oblivion. So that is it's never going to stop. Nothing stops this train. But you must excise that type of mentality. That mentality is not going to serve your best interest. It is imperative that you be rational about this shit. So, right now, folks probably still, at least American folks, are still probably waiting for Fed print to go burr. They're going to cut rates. They cut rates. They cut rates. Look at the yields. Look at the interest rates. Look what's going on in the bond market. Bond market, get that the Fed cut rates. Bond market could care less. So everyone's like, oh, the Fed's going to cut rates. And I mean, look, from a real estate perspective, Fed's going to cut rates and interest rates on mortgages are going to come down. No, mortgage rates up. 10-year up 1.51% today, 2-year up 1.66%. There we look at the 30-year. Basically, market says, I don't give a crap that the Fed cut rates. So all these years, clearly since 2022, everyone's like, oh, they're going to have to cut rates because the whole system's going to fall apart. And they cut rates, and yeah, bond market don't care. So this is a perfect example why the social media narratives are irrelevant. Sentiment is irrelevant. What matters is the inspections that we do when we do our stream. Bond yields are up from 3.69% to 4.02% on the 10-year. Up. And they cut, what, 2+ weeks ago? So that it's just something very meaningful. It's something important to accept and really appreciate about where you want to end up with regard to managing capital. Don't want to be like everyone else. You don't want to subscribe to popular narratives and then just regurgitate them. I'm going to buy Bitcoin because the debt's going to go to the moon. Yeah, that is clearly a statement, but whose debt? Which country? It's all connected. This whole global economic system is like a body and the physiology of a body where everything, every person's physiology is connected. Your liver function connects to your kidney function, connects to your blood function, connects to your brain function. Everything connects. So basically, what I'm seeing in the data is the story that's circulating where China's going to have to devalue the yuan. And that's a statement of money printer go burr? Kinda? Yes, sure, but there's so much more. And it's not the Fed, it's not the United States Federal Reserve. They need to do it because of what Dan says here. So deflation works when basically um, derivative money collapses into a more fundamental form. So obviously, it's all based on M0 fundamental currency units. So US has an M0 that's a fraction of what we got at M2, and they literally just deleverage. The United States deleveraged the shit out of its economics because everyone's like US debt's at all-time high, but that's only a myopic inspection of the overall situation. I posted that earlier. I can find it here. So let's look at the actual data because we got 2008 in there. I have it down here. Debt to equity. Okay, great. That's really high. Yeah, kind of the stuff that backs the debt is appreciating nominally, and that's really a very important inspection. So the debt to equity was much lower in 2007, and they clearly had to inflate the system in order to get out of the 2008 predicament. But guess what they did in 2020? They didn't inflate the monetary supply relative to the total equity in the system. And whether that was their intention or not is irrelevant. What resulted post all of that? Oh, they printed 75% of all currency units since 2020. Yeah, okay. Well, there's been, yes, consumer price inflation, but that is a broad spectrum. Everything inflated in price. And because of that, the equity rose. And that puts the United States in a very deflated state in terms of debt to equity. The US managed to deleverage the United States economy percent. That is a monumental deleveraging. It's very contrary to what popular talking points are. It's very important to appreciate that the talking points surely are correct, but there's a much bigger story. And probably the most interesting thing I could say about popular talking points is I don't give a crap about what the hell's going on in the US right now. So obviously I do as a person that is a local, a resident. I have my municipality, I have my county, I have my state, and I have my country, and they're all that physiological connectedness story that I told earlier. So I do care in that regard. I want social civility. But the story of the day with regard to economics isn't the United States. is China. And China's basically experienced a 2008 collapse of their real estate market. It was inflated beyond our wildest imaginations, inflated beyond anything we've ever done in the United States, and it completely collapsed. You go over to Dan's chart, the M2 is down, but M1 is down significantly more. So notice the history, and that's exactly the way the system works. You need to inflate the a more primitive currency unit to support the derivative currency unit. So in '08, you could clearly see here how they propped up M2 by significantly inflating M1. You saw some deflation rolling over in M2, and they were a bit, so they probably got worried on this first dip over here, if you can see the cursor. So they inflated M1 to support M2, and they've been trading pretty horizontally. So this is very interesting, and it's quite telling on what is almost quite reasonable to play out. So the second he got below this trend line, look at that line, probably about what, nine and change, right here. I don't have a capacity to draw on this chart, but look at that. Look at that level dating back to 2017, and that was a breach between for 2024 to current, right down here, coinciding with an M1 fall off like that. They're going to inflate the shit out of their M1 to support an already declining M2. So what's notable here is probably leading versus lagging indicators. So notice, so they were used to be very proactive. So M2 is lackluster, M1 came down, and which is leading and which is lagging. I think right now they're both lagging, which means they have a complexity on their hands. M2 is coming down, M1 just rolled over to historic lows. And the only way they know to support M2 is to significantly expand M1. They need to get credit going. They need a credit impulse. They need people borrowing. They need people creating these liabilities. And that's how the system expands in good part, aside from productivity. And, well, productivity really, GDP. It's what Raoul talks about, debt plus productivity plus whatever his story is. It's always a good story when he tells it, much better than I do. But point being, that's pretty much what's next. So guess what happens? What's the knock-on effects of that? And that's the story I've been trying to hit home as hard as possible. So right now they got some serious deflation going on. I mean, probably collapse is a better story from real estate perspective, which was a good part of their entire market. So what happens when you have deflation in a country and you need to expand credit, you need to get the economics of currency expansion going again. You got to inflate, which basically means an M1 currency credit impulse to bolster M2. And obviously, if you have more currency going around, that is a way to manifest increased productivity, or at least hope you do, depending on how much malinvestment it is in the system or not. Um, so when you're coming into a deflationary trend and you're going to force economics to break out of that deflationary trend by encouraging credit, that is exporting deflation because they're going to inflate. And that's exactly what we see in like their automotive market, especially. They're exporting all these extremely cheap electric vehicles that have insane tech, very highly interesting and high quality tech. So that's crazy, by the way. Some of their electric cars, like 30, 40 grand, that is literally like next gen tech. So that being said, by exporting deflation, how do other countries respond? Tariffs? Oh, let's put 100% tariff on cheap Chinese imports to prevent importing the deflation. If we allowed 30, $40,000 high-end luxury electric vehicles into this country, what happens to the domestic brands? They probably fail at some point, and that's deflationary. people need to really correlate the concept of deflation with everything failing, companies going bankrupt, and collapse of productivity. Because that's what deflation translates to, or that's what basically price going down translates to. And that's why price always needs to go up. So, in response, um, aside from tariffs, countries can do their own economic soiree of juicing credit, lowering rates, injecting stimulus, subsidizing, tax breaks to juice productivity and get increased domestic auto sales and to compensate for the um, uh, avoiding tariffs and allowing those cheap autos in. But now our country is going to subsidize autos so the domestic product is on par, at least price wise, at least competitive. So there's a couple of different approaches nation states are going to take. No, no, all the nation states are not going to collectively do exactly the same thing. That's just the nature of humanity. Everyone's going to do what the hell they want to do. And in the end, what happens is margin call. You're not panicking if you're first out the door. So are they panicking, China, if they're the first to execute a historic credit impulse? And then that cascades, that has knock-on effects. If they're doing that kind of stimulus and that kind of monetary function, everyone else will have to in a dominoes type of fashion. Now, this is exactly what we just came out of between 2022 to present. Everyone had to tighten, and nobody could tighten more than the United States. So everyone's playing catch up. Everyone's trying to tighten as much as possible. And Britain eventually tightened to the point where they blew up the gilt market. But that was because the US was tightening. So it works both ways. The knock on effect, if someone's tightening, ooh, someone else has to tighten also. But now we're on the other side of that cyclicality. And China is going to have to blow out credit. And that'll cause everyone else to subsequently have to do the exact same thing. Now, maybe the U.S. is the last to execute accordingly, but maybe not, because there's a whole lot of debt that the U.S. has been printing, and interest rates are too high. But if the long end rates, let's go back to the chart, the long end rates are going up. The U.S. is constantly issuing bonds, bills, notes, treasuries. So, and there's usually a balance. And his, most recently, Treasury has been skewing that balance towards short term bills and notes. So, why are they doing that? Because they have a lower date to maturity, which means they could roll them over into lower interest rates. The longer term stuff, who's the hell is going to issue 30-year at 5%? Now, obviously, they've been doing that, and they want to keep that to a minimum. So they've been adjusting their issuance. They can't do it too much because then everyone's like, "Oh shit," they're freaking out. They can't, they really can't handle printing $2 trillion, 5% for 30 years. So that's an interesting takeaway to how the U.S. may adjust. We may see maybe significantly increased skew towards the short end, considering Fed's cutting rates, but the long end is still going up in yield. It's back over 4%. They're losing control over the long end. So when you see the Fed cut rates and the dollar strengthening from 100 to 102.4, that's not control. That is obviously a ramification of the weakening yuan because they need to devalue the create the credit impulse. That's going to strengthen the dollar. By China doing what they're doing, considering all things considered, they're neutering the effect or the needed effect of Fed policy interest rate cuts. Fed needs long rates to go down. Clearly, with the reverse repo and the overnight repo, um, they have a degree of control over the short end. But we also saw some of that stuff blow out as well. But broadly speaking, they have control over the shorter end, 10 years and lower of the bond market. So that doesn't tell the whole picture though, because if they don't control the long end, you still need to issue long-term debt because you can't just issue the short end because then everyone's like, cat's out of the bag. They don't have control. Um, so we're in a place where at some point, China keeps doing what they're doing, or dare we say they blow it out, and U.S. long-term debt keeps going up, 4.25, 4.5, 5%. Yeah, that's going to kind of force what everyone talks about. The historic quantitative easing from a Federal Reserve balance sheet standpoint, if they need rapid firepower. Treasury buybacks is trying to adjust the yield curve. It may not be in a position to significantly suppress long end rates blowing out, which would be really weird with them cutting interest rates at the Fed. But mechanically, it would make sense. Obviously, Basel III Endgame is engaged, so we'll see how much of this the primary dealers, the banks, will be able to absorb. But those are your systems, those are your mechanics, and how all of this works and why it works. Why would the Fed need to buy long-term debt versus short-term debt? They're adjusting the yield curve. They're adding a bid to the system that didn't exist outside the system because rates are going up even though their Fed policy is coming down. They're trying to adjust and compensate for lack of market activity to make the condition of the United States debt market favorable for continued deficit spending, which is the prevailing story of fiscal dominance, where we can't take the foot off the pedal. Nothing stops this train with regard to deficit spending because that's not even a non-starter at the political level. And not even from optics, but they literally mechanically probably can't even do it because they've already approved the spending. They spent it before they've even earned it, one, and then they've spent it before they've even created the debt for it. It's literally just pre-spending. Really wild. But clearly they can't do it. And coupled with the 30% deleveraging of the entire financial system in the United States, they could do it a lot. So that's quite an interesting takeaway. That's a very contrarian type of chart that we're looking at right now with regard to prevailing sentiment that it's over, the end is over, that the dollar is going to fail, and that it's going nowhere. I mean, literally, they just cut rates and the dollar shot up 2 points. I mean, that's big. That's 2%, 2.4%. So I was at 100. Boom, 2.4%. That's a massive, massive move in currency markets. Why? 2.4% means instantaneously, anything that any other country wants to buy in dollar denomination just went up 2.5% in a week. That is by definition inflation. Okay. So inflation so much more than what people talk about. So important to understand these mechanics. The better you understand this shit, the more comfortable you could be with how it plays out, why it plays out, when it plays out. You're like, all right, fine. You know the destination. The destination is China rolls over and creates the credit impulse, causing everyone else to cascade into a credit impulse, causing the U.S. have to cascade into a credit impulse, potentially even managing excessive yields in the long end, so they don't fuck up the Treasury market with all of the debt that they need to issue, and don't cause a panic by skewing any further to the short end. So all of this is baked in the cake. In good part, I don't know if 100%. Clearly, retail doesn't understand this stuff, but institutions mostly do. So, why do you think Bitcoin is sitting where it's sitting at 63,700? Why do you think? Look what happened back in 18. I was literally the cycle before last cycle, leading up into last cycle. This did this. Let me highlight so I'm not saying this too much. This looks nothing like this. This was weakness. That's weakness. That is a retest of the 50 SMA on the monthly chart, ladies and gentlemen. That was a breach of the 10. That was a breach of the 50 as well, a wick below. Going to the weekly chart. There was interesting stuff with the 200 SMA, which is a little bit more constructive to highlight what the hell just played out. Weekly breach of the 200 SMA back in March of 2020. That was extreme weakness. Let's move this around. Let's put on logarithmic and look how much more weakness there was in 2022. That was an absolute breach of the 200 SMA for a long period of time. People were screaming, it's all over. It's going to zero. And then you got a fat inverse head and shoulders at the bottom. Big structure here. And then a big BART. That was a massive BART. November 22 to January 23. Massive, massive BART right there. Crazy. That ain't no head. That's Bart's head. And to the point where we're actually sitting. Boop, boop. Let's increase. Zoom. We're literally sitting at all-time high. I don't care 74. That's irrelevant to me. It could be 60, 70, whatever. It could be 55. This is all-time high from a moving average standpoint, from a long-term candle body close standpoint. The damn Bitcoin price is sitting at all-time high. Holy crap. So that's what I would call a forward-looking indicator on exactly what China's going to do, exactly what the knock-on effects are going to cause around the world, if exactly how the U.S. is inevitably going to have to respond because of deficit spending requirements, fiscal dominance, have to adjust long-term rates, have control over the short-term rates. How do we know? The reverse repo has achieved. Look at the deficit that the Fed is running to Treasury. So that in itself is a currency printing mechanism. Their deficit is an expansion of the currency supply. They're not taking out of circulation what they need to pay to Treasury. They actually don't have it. So that's just fascinating to say the least. But that's just what where it's heading is so big that's the cake. If you're on X or you're on Twitter. If you're on X or you're on YouTube, please feel welcome to post any comments. I'm more than happy to answer anything on your mind today. Hope I covered some macro that is interesting. Hopefully, this shit brings comfort to you. That's what it's supposed to do. Be like, all right, I'm not a holder anymore. You're not a hodler. You own things that are aligned with the macroeconomic directionality of the system. Countries aren't going anywhere. And if they are, Morton Joe is our president, in which case, who gives a shit? So countries aren't going anywhere. Dollar's not going anywhere. All these geopolitical games are inevitable. Geopolitical conflict is always inevitable. These currencies are going to exist. Might as well understand how these currencies work. You might as well understand the relationship between currencies, the effects that debt markets and currency markets have on the next country, then the next country, then the next country, then to the US and back again, and the interrelationship between all these nation states and all the pressures that are placed on the system. Might as well understand this. Because that is the only way you're going to buy anything other than Bitcoin and be comfortable. So that's something that I finally not realize, but it's all connected. Bitcoin is so meaningful to the system in so many regards, just as gold is, but so are these fintech businesses. Because the banks are big, but the banks are a bunch of dicks. So that's big sentiment right there, where you have a disintermediated, globally accessible permission banking infrastructure, not built by the system, exist in the system. And that is a perfect example of exactly what Satoshi originally talked about, and folks, um, how Finney talked about. You got to build something they, they can't shut down, or something that's resilient. And you build it the best you can. And the strongest one will survive. And the strongest one, like, look, they shut down Bitcoin mining in China. It literally all migrated. basically to the United States. And that's the same thing that happens with even proof of stake. It'll just migrate. So that's called geopolitical arbitrage and geographic arbitrage. Arbitrage. That's the beauty of these networks, monetary networks. They're backed by a capacity to arbitrage, and that creates a degree or a significant degree of resiliency, survivability. We talk about that in terms of individual protocols, but that property also exists for the entire market, the entire economic construct, the entire network. Resiliency. Anywho, Joel's in the house. Much pleasure. Morning. DCA Cap. DCA man. Hi, Cap. Arrow, good morning. Much pleasure, my friend. Asun, good morning. I am DC. Sir Joe, present. The French economic minister has announced that he was going to propose 0% interest borrows to help relaunch the economy. Inflation is coming to France. Well, bear in mind, if you have a strong credit impulse and all that borrowed capital went into agriculture and mining and refining, you're increasing supply. So inflation isn't what people think it is. So inflation is really a manifestation of excess currency, but maybe even more so malinvestment. So that's just something important to at least understand the mechanics of. You print the $1 trillion and it's all spent on farms, and you triple the food supply and triple the warehouses and the logistical supply chains. You triple manufacturing of natural resources and processing and refining. There's no consumer price inflation. You probably have consumer price deflation. So that's so important because everyone goes around screaming the fucking inflation. Listen, I appreciate it. I hate that shit. I am 24% less wealthy as compared to 2020 because I haven't gotten a pay raise at the office in 4 years. So I'm feeling the pinch. 1.98%, lower than Fed target. We're sitting at 26% since 2020. So unless you got a 26% raise at the office between 2020 and today, you are literally making 26% less of a salary. That's fucked up when you think about it like that. Now that's real, but it's more than 26% because obviously housing price inflation is significantly outsized. So lots of considerations there. Truly the rat race, the trading labor and time for salary. You really need some heavy hitting leverage to get a 26% raise. I mean, historically, if it was the 2010s, I just say put your resume on and get another job because that's just my experience. Always better to get another job. I went from job to job to job to so many jobs. Oh my God, what I did in the 2010s. And the double contracts, that's just unhealthy. I, I was that was very unsustainable. The double contracts I did for many years. But whatever, past is past. We move forward. We grow, we evolve, we make the best decisions possible, and we create our dinner table stories and we invest. Oh, that is the biggest recommendation. That's the biggest encouragement I give to 20-year-olds in the family, cousins and boyfriends of some of my cousins and girlfriends of some of my cousins and just my cousins. Buy shit. Gotta own shit. 'Cause that's what they always say. What, 99% of all assets are owned by the wealthy? Oh my God. The whole country has been seeing that headline forever. And still, the majority own nothing. It doesn't have to be real estate. Yes, it's obviously stocks, depending on capacity, qualification, skill set. But look at the conversation we're having. We're having a conversation about how to increasingly understand the system, to find comfort, to own things that are going to respond asymmetrically, the shit that even retail doesn't really follow. Everything we do in the crypto space is off the radar of the general public. And the general public's like, I'm going to buy some stocks. I'm going to buy some GameStop. Is it on Fidelity or Charles Schwab or E Trade? Or can I get it on Robinhood? All this crypto stuff is such a microcosm of a percent of the population. It's truly contrarian. Still to this day. Yeah, it's the whole we're early narrative. That's still in play until it's not. And that is comforting when you understand the mechanics of the system basically indicate that's inevitable. System only goes one way. You don't put Pandora back in her box when you create a globally accessible permissionless bank that is accessible to everyone around the planet. Yeah, these the banks have no chance in time. There's no way to know how much time. Who gives a shit? But that gives you the capacity to make a rational inspection and say, okay, I understand what I want to own. And then when do I want to own it? And then at what price do I want to own it? And then speculating on can I get the price? This is the whole XYZ narrative. How much does it cost? How much is it paying? And how likely is it to continue to pay into the future? I want to buy interesting things that align with the way I understand the global financial system, that have a high degree of resiliency to exist into the future, and they pay today. All right, fine. They're not paying the best. That's okay because we have the concept of immutability, which basically guarantees it's going to exist into the future if the contracts have been proven resilient. Fortunately, we had 2022. What was 2022? 2022 wasn't what people think it is. People think of 2022 as a bear market where price goes down. 2022 was literally the great filtering of the first epoch of crypto fintech. That's it. The weeding of the bunch, the flash fire, the thinning of the herd, the truth teller of who is resilient, who has the capacity to survive, who has the meaningful utility, who offers the most meaningful fintech business that people want. And we see that reflected, and it's still here. You get that one? You get that? We see that reflected not in price go up, but we see that in the fact that there's plenty of protocols that didn't get exploited. Plenty of protocols that just, drifted off into nothingness. Not through necessarily price depreciation, just people stop using them. They evaporate into the ether, but not many. How many? It's not many. Not many. And the meme coins, collateral, culture, gambling, great, groovy. Not part of this narrative. Whole different story. You probably like because Bitcoin. I go on because Bitcoin. I talk with those boys. I appreciate that aspect of these markets, but it's independent. It's not mutually exclusive where, all right, meme coins are going to do better than fintech enterprise. It's just two sides of a financial system. And that's quite reasonable. And it's imperative for me to appreciate that side of the financial system because in the future, what is all that? What is all meme coins? That's all collateral. And what do you do with collateral? You print currency. And who when you print currency, who do you pay? Me. So y'all have your fun. It's all good. I got more patience and more time than anyone. I know where it's heading. So go ahead. Monetize your meme coins. 500 bill. In 10 years' time, we'll see $10 trillion corporations on NASDAQ and whatever. And we'll see $1 trillion meme coins. It's great. Go get them. I'll take 20% on 100x any day. Because folks put in the meme coin work, got to put in that work, that time and effort, a little bit technical analysis, a little bit of gut instinct to know how to bop and move. It's okay. The most important thing you do as a capital manager is know what your skills are, know who you are, and express that. with confidence and comfort. So important, ladies and gentlemen. If you're on X or you're on YouTube, please feel welcome to post any comments. I am more than happy to answer anything on your mind. Flip through the charts, curve back up to 26 cents. How much constructive? It's like, um, how much can we talk about here that's not talked about on social media? We're down here at the bottom. Zoom into the daily. This is like a line in the sand right there, 26 cents. And I don't do Elliott wave on this chart, or I don't look for. I look at levels and I look at the same shit that I always look at. Still need to break above the 100 SMA on the daily. Bit of an inverse head and shoulder structure, like a quadruple shoulder. This dude has four shoulders, one, two. There's your head, and it's literally like the head from Beetlejuice. It's literally a wick, and then head, and eventually this thing breaks through the 100, and then you get resistance at the 200, 37 cents. Meaningful appreciation to get the 37 cents. So that's going to take its time. Convex hovering around $2 forever. I keep an eye on Spell for a couple reasons. Primarily, they're they've been the best payer of vote rentals in the entire throughout the history of these markets. Threshold Network as well. Threshold and Abracadabra and Frax, but Frax is very marginal. They're the ultimate recycler, so they recycle everything in the vote rentals. But um, notable Abracadabra and Threshold as well. I mean, dollars basically a little stagnant today. Maybe a tweezy top and a big reversal. Maybe fall back down to 101.79. Would be interesting. Heading. This is Q4. This is the time where we figure out how we're going to get to the destination. We're going to see it. We'll see it in the headlines. We'll see it in China and credit and stimulus and rates and whatever the hell they do. And then we'll see the knock on effects. We'll see ECB with their announcements, cutting rates, stimulus package. Maybe they do what they said they want to do is consolidate the bond infrastructure. So they're a centralized currency issuer, the ECB. Maybe they start issuing debt and purchasing each nation state's debt in some sort of buyback program in order to become both the, the debt, uh, the authority on debt as well as currency for the European Union. And we'll see it out of the United States as well, especially it's Monday. We have big hurricane coming into Florida on Wednesday. I'm cool. I'm more south, but a lot of people aren't, and massive cities are evacuating, and that's all inflationary because when Congress is forced to approve a FEMA budget, um, where does it come from? It comes from debt issuance, and that debt issuance is up only. So the destination, and that is so clear over and over. That brings us right back to long end rates, and they are cutting of rates, not impacting long end rates as they really need from a fiscal perspective for them to continue this degree of deficit spending. So it's just fascinating to watch all this shit play out. Gold 2640 is barely budging down. This is like a consolidation range at best. No real technical structure, even from a daily standpoint. Obviously pushing through the 10 SMA, but not pushing down through it. Albeit this is from a daily. So yesterday, what's Monday? So that was Friday. It did wick below 10 SMA, and now we opened below it. So constructively, this is potential rollover territory unless something happens from a global standpoint that invalidates this breakdown. We'll see. We'll see. This is all this shit is always followed with a let's watch because who cares about pontification? Who cares about "Hey, what do you think is going to happen? I don't care what's going to happen. What I care about is what's going on today. 'Cause I know the destination. The destination is, oh, what's going to happen to the price? The destination is what's going to happen to the system. How do these countries maintain solvency? How do these countries maintain gross domestic product? How do these countries maintain social stability? How they do it, we got to watch. and that doesn't imply price necessarily. Here's another interesting point. Yeah, this one was interesting by Zero Hedge. Break it out. Brent's milkshake relationship between China and India. So China is doing stimulus, trying to get their M1 back up to M2, create a credit impulse, what have you. What's it doing to India? Exactly what I always say. Exactly. Underperformance chases outperformance. What do you think happens if China? This is exactly. Let me explain this, and I may end on this note unless anyone has any questions. So China does a massive credit impulse, and their market goes parabolic, and it starts putting pressure on Japan, and maybe the spread increases between um, JGBs and Fed funds rate, or rather JCB and the FFR. Um, and that encourages carry trade unwind. Combined with the Chinese market going parabolic, what do you think that does to U.S. equity that are underperforming? They're not going up 20% a week. Meanwhile, China's market's going up 20% a week. Sucks the capital right out of the market. And there you go. There's your turn. There's your rollover of currency flow from a country into another country, from underperformance to outperformance. And here's the kicker, any country could do that at any time by turning on the quote unquote money printer. But there's implications. So that's where we are. And that's where all these countries are with regard to thinking about how to respond to a yuan deval. And let's watch. That's all we could say in that regard. Um, Anything else interesting in the charts? Tapioca back up to 187. Nice horizontal range, in my opinion. I threw some liquidity for the first time on Ramsey's. Probably going to add more. And then Wednesday, I'm going to throw my vote on it, which is a relatively large vote. Might be an interesting place to get to participate. I don't know. I never do liquidity, but I'm kind of trying to get a little bit more comfortable with it because I have some liquidity that I will need to manage towards the end of the year, and I have these extra assets sitting around. I have very few liquid assets. My portfolio is basically illiquid. It's completely illiquid. It's like 95% illiquid, which means I basically have 95% unrealizable, or there's no fair market value. You can't sell any of this stuff. So that brings up very interesting accounting questions that we've talked about historically. But this TAP is something that I was a seed investor. I might have been an investor for all I know, but it was early stage, and this is something that I intend to just lock everything. But I'm also providing liquidity because liquidity is something that makes these markets go round. Can't do anything if there's no liquidity. So best thing I could do, considering I have my Ramses exposure, I'm going to throw my vote behind it. So everything that Tapioca offers is on Uniswap. All right, let's get some Ramses action going on, considering the voting power. Vote on my own. That's what historically you were supposed to do. You have a liquidity position and you want to bolster activity for your liquidity, and that encourages a business, be it a protocol or me, to acquire voting power to direct incentives. So instead of 5%, it'll be 50%. And that's surely going to have an impact on liquidity in this particular LP. Maybe I shouldn't have told anyone that. Maybe I should have just kept that shit for myself, considering I'm going to throw 1.4 million VE RAM on it. Tell anyone. Um, Damn, I probably really shouldn't have said anything. Anywho, that's something I need to do because I love to own businesses and I really want some additional exposure, like maybe a Phantom or a Suey. But how do I get exposure? I'm not buying FTM and I'm not buying Suey. I don't want to own fucking gas tokens. I want to own a business. So I'm very hopeful that Kingdom expands to Phantom, which I think is going to happen. I know Kingdom is expanding the Fractal. Great. So there's your freebie bag there. In fact, while I'm on the stream, why not? I get nervous because I missed the Nuri, and I don't want to miss these. So I'll do it right now. Why not? We'll sign that bad boy. And we will extend the lock. I mean, I just get nervous because it was literally like 28 days. I missed it by a day, locking for a day. So I'll keep this bad boy topped up. It'd be nice if they did like a silly expansion. I heard that there was a V33 over there. But Andre talking about most recently the V33 is not taking advantage of his most interesting um, productions, his most interesting innovations. It's quite constructive. Because what's he up to? What is he going to do with Sonic? I find that fascinating. I find it fascinating to think about these things because we have no idea. We're trying to get into the head of someone else and their behavior and their actions and intentions and plans. Something is very interesting about because something is very interesting about Andre. Just like something's interesting with Suey, and something is still very interesting with many other things, and the list goes on and on. So you have to pick and choose. So right now on my interest meter, I already have all the interest I need in like an Arbitrum, Optimism, Superchain, Arbitrum Orbits, Mainnet, Cosmos, Polkadot. I got plenty of exposure. What are the things that I could potentially add exposure to? Probably I do have solidly on Phantom, but that's so microscopic. It equals probably more interesting on Phantom. But in any case, hopefully we get a Kingdom deploy over there. That would answer all those or resolve all those considerations and complexities, wouldn't it? DCA man, did you see the smart LP on Jones with Tap ETH? Let's take a look. Jones Dow. Nope, not Discord. We'll take a look live on stream. Why not? And I connect. Great. Let's see what's going on. Oh, jurisdiction. Terms of service. Uh, huh. Where are they getting this yield from? Is that going to Uniswap? So it's automated liquidity management. Obviously, it's concentrated. So they offer you a wide or narrow 139% on the bull strategy. Huh. Interesting products. So, by the way, ladies and gentlemen, this is called a derivative product. And it's one of the four products that exist in crypto. There's only four: FX, credit, liquidity financing, and derivatives. Four. So this is interesting. That's cool. While I like that, I also have 1.4 million VE RAM that I could throw around, and we'll see what that does. So I'm curious to see because why not? Why not? Give it a shot. Maybe all of a sudden, maybe we'll see. We'll see what 1.4 mil does. Captain, do you reckon Fed will end QT in the next meeting? I don't know. There's no way to know. Um, I know pressure. If the yields on the long end continue to go up, that is putting significant pressure on Treasury's capacity to finance deficit spending. And we know one thing above all: there will be no reduction in deficit spending. So that means the pressure builds on Treasury to facilitate that financing. Um, that will govern the Federal Reserve and their capacity to massage Treasury's deficit spending capacity or financing capacity, more precisely. Who cares about QT and interest rates in the US? That's the biggest thing that people need to process. I'm not looking at interest rates in the US. They just cut 50 points and it did jack shit. So why do people look at interest rates in the US or even QT? I'm looking at China right now. I'm looking at Japan. I should be looking at the yuan, but I don't have it up. Oh, 148. Watch, we get a nice rejection. That'd be a double top, double rejection, and there you go. Yen starts appreciating again. Carry trade unwind is back on the table as a narrative. And to top it all off, yen starts appreciating, and China does some crazy M1 credit impulse. And what do you think that's going to do to U.S. equity markets and all this overpriced pig shit? I wouldn't want to be an investor in the United States in that particular scenario. So, in that regard, I'm more comfortable, calm, cool, collected than ever owning what we own in crypto. Because it's not an American market. It is not a US market. None of it at all is a US market. If you got all of a sudden a great capital expansion in China, all the way out in the east, or whatever, in Europe, wherever, they are all investable. All those investors have a capacity to allocate capital to crypto markets. All these people around the world have a capacity to allocate capital from underperformance to outperformance. That's all a crash is a rapid reallocation from shit to good quality stuff that's being appreciated by more and more people. Hope that helps. Joel, bond yields still way up in terms of favorable market conditions for digital path. I understand the destination, but I think there's a lot of inflated hype around crypto currency price action. Well, fortunately, you're on the stream where cryptocurrency price action doesn't really mean anything. We talk narrative, fundamentals, story, capital management. I think any hype on social media, anyone who does anything that's hype on social media, it needs to be understood as laughable. Oh, I'm expressing my sentiment. Oh, it's so exciting. The price is going to the moon. Uh, Grow the fuck up. Not you guys. Talking about social media and all that emotion. It's gross. It's really gross. Don't be desperate. Be excited. I'm excited. I'm very excited. I know of what I own. I'm grateful for what I own. Proud that I put in this work to build this portfolio that would get laughed at by meme coin traders like, bro, you held down 80%. Bro, what did you do? You're an amateur. You know what you're doing. Oh, oh, my friends. There's so much more to life. There's so much more to being old and wise and how to navigate this path like a captain, a robot captain, if you know what I'm talking about, such as the imagery that I've been using lately. That opinion, that sentiment that is so easy to express means nothing. It's irrelevant in the grand scheme of things. Always remember that, ladies and gentlemen. That's going to take us to the end of the stream today. I appreciate each and every one of you. It is Monday, October 7th at 12:59 p.m. 219 people made it to the end of the stream. Each and every one of you are super awesome and a little bit more rational today for sticking with me to the end. I wish you all a wonderful Monday. I hope anyone who's down south on the west coast of Florida is safe. Evacuate. Don't mess around in Tampa. It's not worth it. Not worth it. And I will see you on Hurricane Day because I will stream uh, unless, some crazy shit happens further south. But otherwise, I'll be here. And maybe we'll talk weather. Have a rational talk about weather. No, that probably bore people, but we'll have something to talk about. Y'all have a good one. I'll see you later this week. Peace.